Chapter 10, Learning Objective 4, reviews basically two things: how liabilities are reported on the balance sheet, which should be very easy to review. And then there's some analysis that we're going to review. I think you've seen the analysis before, but you have to go way back to Chapter 2. All right, so hopefully they'll be familiar. So here is a partial balance sheet showing that liabilities are reported right in two ways. The current liabilities are listed first, long-term liabilities are listed second. Again, the current liabilities would be listed based on whatever is due within the year of the date that would be on this balance sheet. Right? And notice here you have the current maturities of the long-term debt that are included. Anything that's a long-term liability would be due after 1 year from the date on the balance sheet here, and your typical suspects are here, like bonds payable and some notes payable that are due in the long term as well. So not much going on there. You've sort of known that from your classified balance sheet days. Okay. Well, some of that's going to be coming back because I think classified balance sheet was chapter 2. So some of the stuff is going to be coming back because some of the analysis that you were introduced to then is here again. To help do analysis, we need to be able to read our balance sheets pretty well. And so this particular balance sheet is a summary from General Motors company for 2013. Numbers are listed in the far column, 2014 in the middle column here. Here we have current and non-current assets, listing total assets, and then current and non-current liabilities with total liabilities and total stockholders' equity separated out for you. Okay. So one of the first things we're going to need to analyze is, the liquidity of a company has to do with its abilities to pay its short-term debt, right? And so the most common way that we look at, or the common ratio that we look at for analyzing liquidity is that current ratio. And that's when we compare the current assets to the current liabilities. You probably remember that from chapter 2. And so for General Motors in 2014, looks like they had over $83,670,000,000 of current assets compared to $65,701,000,000 of current liabilities. So they had a current ratio of 1.27 to 1. And again, how to read this is, you probably remember, they have $1.27 of current assets. That's that first number to cover every dollar of current liabilities. That's that second number. So that's how the ratio is read. In 2013, their current ratio was 1.31 to 1, which meant they had $1.31 of current assets for every dollar of current liabilities. So their liquidity ratio, the current ratio went down a little bit, but still around the same area, roughly speaking, about $1.30. Compared to the industry as a whole, as you see, the industry is not very liquid. It's got basically a 1-to-1 ratio, which means it has most of the companies in the industry, the automobile and light truck SUV manufacturers, have $1 of current assets for every dollar of current liabilities. So it's not the best situation there, because it could mean that their short-term ability to pay, you need cash and you need things to turn into cash. So you might, some cases, need to borrow money to pay your bills if your liquidity ratio, like your current ratio, is really tight like that. Okay. And some solvency ratios. This might also ring a bell. Solvency has to do with managing long-term debt. So I want you to look here if you can. I mean, I really feel bad if you just had like an eye exam and like, shit, I thought my glasses worked fine. They do. This is just really teeny tiny. The debt to asset ratio we did review in chapter 2 back in the day. Total liabilities are compared with total assets here. That's what this says. You'll have to trust me if you're squinting. And so for the debt to asset ratio for General Motors in 2014, you have 141 billion in total liabilities compared with 177 billion in total assets. And that means their debt to asset ratio is 80%. That's very high. Debt to asset ratio means the percentage of assets that's bought with debt. So 80% of their assets are financed with liabilities. So that's a pretty high ratio. In 2013, it was 74%. So clearly it's gotten higher. So one of the questions this might tell you here, or you might need to answer is, well, they have a lot of debt. Are they able to manage it very, very well? And particularly compared to the industry only has a 62% debt to asset ratio. They're much, much higher than that. So how are they doing? Are they able to handle their long-term debt? Well, that's what the second ratio kind of gives us a hint as at answering. The times interest earned ratio helps us understand how many times the profit of the company covers the interest payments that they have on their debt. Okay. And so here you have a ratio that's calculated by net income plus the interest expense plus income tax expense divided by interest expense again. Okay. And as you see down here, when they add the net income to the interest expense to the income tax expense and divide that back over the interest expense, they're able to cover their interest on their debt 11 and a half times over their profits. That's much higher. You see, the industry is only 3 times. So the industry, yes, has less percentage of debt in terms of debt to asset, but they're paying a significant amount of their profits towards covering the interest on that debt. Whereas for GM, at least in this year, they had over 11 times as much in profits as that they owed in interest. Okay. So solvency ratios are about long-term debt. Okay. And by the way, this times interest earned, where they have the net income and interest expense and income tax expense, that's why these numbers are given to you here in this box. This is where those numbers came from, this particular box. So they will give you those to calculate. It's not like you're going to have to guess. A couple of other things here very quietly mentioned. There are things called contingencies that corporations have to deal with. And the most common contingency that you would know about regularly is simply a warranty on a product. So for example, since it was a car, they looked at GM's financials. I'll stick with the car industry. So let's say you buy a new car and the manufacturer says, look, you'll have 5 years or 50,000 miles warranty on this car. We guarantee it. Okay. So what they did is they basically gave themselves a possible liability, right? Because it could be possible that that driver who buys the car drives it for 5 years or 50,000 miles and there's nothing that happens. And so they don't owe that person anything. But there might be other drivers that get in their cars and they drive and something happens. Something might be defective or needs repairing. And thus, under the warranty, they owe that to the customer. They owe that work to the customer. They owe those, so they owe the work or they owe the parts, right, to replace it. They owe that. So it's an uncertain outcome. We don't know whether it's going to be a very big liability that they've created or a smaller one. It sort of depends on how those go. When they have a recall, it's horrible because, right, they basically have all these are under warranty. They certainly made a mistake and they're fixing that mistake by recalling it. So they owe all these customers all this work or an extra part or whatever it is they're doing. So a product warranty could be a small liability to the company, could be a big liability to the company. It's uncertain, which is why we call it a contingency. Um, Another type of contingency that you'll hear a lot about too is lawsuits. I mean, all companies get sued. I mean, I don't think we live in a very litigious society, so everyone loves suing each other, I suppose. But corporations are no different. They get sued, and they sue. They sue as well. Sometimes those can be for a large problem and cause a very large settlement or a large payout to be necessary. So it's quite possible that certain lawsuits could create a large liability for a corporation if they lose that lawsuit. Again, it's an uncertain outcome because we don't know what's going to happen at the trial. If they lose the first round, could they appeal? And so it still remains uncertain whether that's really a liability or not until, I don't know, what, the cow comes home, the crow calls, the fat lady sings, whatever you want to end that sentence with, until we know for sure. It's not over till it's over, Yogi Berra. I'm going to stick with that one. Okay. Same thing, companies also may have an obligation that they might need to do for environmental reasons. They might have polluted the groundwater, they might have polluted the air. They might have done something where they violated regulations and so forth, and they might be faced with various fines of some sort. That's also relatively uncertain. It does happen, but all of those create liabilities for the company. The important thing to understand here is all of these things create potential liabilities for the company. Okay. And so companies are required to disclose these contingencies in their notes to financial statements because they don't know whether it's going to be a liability or not yet, but it might be. It might, they don't know. So they have to basically say so. So that's important to know. And the last thing, we've talked a little bit about leasing in the past, but normally speaking, how leases work is, they do get use of an asset, but they also have to pay for that asset. So in general, most of the time leases cancel each other out. They're both assets and liabilities. And so oftentimes they're not listed on the balance sheet. Okay. They need to be listed in the notes to say that they have so much of their assets under lease. Okay. So this is one of these types of things that are very important. Leases can sometimes create a lot of liabilities that the company is not disclosing. Okay, because some of the terms of those leases, some of the arrangements could cost the company a little bit more. And so sometimes we call some of that stuff off balance sheet financing, because they clearly have an obligation there, but it's not showing up on the balance sheet. And it could be a big problem. Again, they're supposed to be disclosing lots of information regarding this. Doesn't always happen that way. So sometimes leases, although it's usually a wash, they're both assets and liabilities in most cases. So it's usually not even an issue. Sometimes can be a problem. All right. So here we go. We're at the end of learning objective 4. And as you see, this is really all about ratios. So here is Trout Company. They have the following balance sheet information for you here. Your current long-term assets and total assets are listed here. current long-term liabilities, stockholders' equity, and the total liabilities and equity are right here. In addition, you have information about Trout. They have net income, they have an income tax expense, they have an interest expense, and then so we go to the computations. The current ratio is the current assets and the current liabilities, right? So that's the two numbers that are compared for that. And so 10,500 of current assets, 8,000 of current liabilities, you're going to have a current ratio of 1.31 to 1, $1.31 of current assets for every dollar in current liabilities. They also bring up working capital here. So working capital, again, going way back to chapter 2, is simply the difference between these two. It's current assets minus current liabilities. And so the working capital for this is $2,500. Current assets minus current liabilities is working capital. Part B indicates a little twist. Let's say at the end of the year, they use $2,000 cash to pay off $2,000 of accounts payable. So they have less current assets, but they also have less liabilities. So what would the current ratio be if they use $2,000 of cash to pay $2,000 of current liabilities? Well, their current assets would now be $8,500. Their current liabilities would now be $6,000, right? $2,000 less on both sides. So that would mean the current ratio actually looks better, $1.42 of current assets to every dollar in current liabilities, 1.42 to 1. However, working capital is the same because when you subtract the difference, it's still the same difference. So no change on working capital, but certainly current ratio looks better. The last thing they want you to do is compute the debt to asset ratio. So for the debt to asset ratio, we need the total liabilities. So you need to add your current and long-term liabilities together because they don't give you the total outside of that. And compare that with your total assets, okay? And so that ratio is going to be 24,000 over 34,700, which means that their debt to asset ratio is going to be a little over 69%. So they 69% of their assets is financed with debt. That's basically all that means. The times interest earned is where all these other numbers come from, right? The net income plus the income tax expense plus the interest expense divided by the interest expense to get the times interest earned. And there it's nearly 20 times, 19.67 times, which means that the profitability of the company, in this case, is really a 19.6 times larger than what they would require for interest payments on their debt. So very high and a very, very good ratio there. And that is chapter 10 in a nutshell. Told you, 20 minutes.